Wild ride for the major averages today as trade tensions between the U.S., Canada, Mexico, and China reach new levels. Our next guest says the volatility isn't going away anytime soon. Let's bring in Cantor Fitzgerald, Chief Equity and Macro Strategist Eric Johnston. Eric, welcome. I'm specifically wondering about how long you think this lasts. We had Commerce Secretary Howard Lutnick hinting that perhaps there's a compromise in the offing. But, listening to Mexico, listening to Canada, the feelings seem bruised. How much of this chain yanking can go on before they start to view the U.S. as less than a reliable trade partner, and that has a long-term impact on the economy and the markets?
So I think you're right. It's going to remain, extremely volatile. The news flow coming out is going to, remain extremely volatile. But what's happening is that over the course, right now there's so much uncertainty in the economy, and it's impacting how businesses are investing, how they're hiring, how they're planning new orders, and it's showing up in the data. And we don't expect that to change, anytime in the next 4, 6, 8 weeks. There's going to be variability around what is tariff policy, what is tax policy, and how the changes to immigration are actually affecting businesses. And so essentially the economy is almost going to be stalled for a period of time. And I would expect that when earnings season comes in April, that there's going to be some issues with first quarter earnings and also with guidance. Now, before we get there, the sequencing of the news flow, I think, is really important. And we've seen a significant amount of de-risking in the market. And so to your point about volatility, I think there's a real possibility that we can get a snapback rally because of the de-risking that has already occurred, and because we've gotten the negative tariff news about the tariffs being put on. The next piece of news that we get may be that they're coming off. And so it's going to be this back and forth. But I think the direction over the next 6 to 8 weeks is down, but we're going to see squeezes along the way.
Okay, so investors should do what then?
So as far as a portfolio, I would say for those that are shorter term, from the downside, I think financials is the one cyclical sector that has not sold off yet. And if you think about financials, they're levered to credit, they're levered to loan growth, levered to capital markets. All things that don't perform well in a slowing economy. And then they would benefit from rate cuts, which I think could be trickier right now. Even though we're seeing slower growth, inflation remains high. I think there's a short-term long opportunity in some of the high volatility momentum names. They've gotten hit very hard, and they've been, in many cases, de-risked. And I think you're going to see a likely bounce in the short term in those names. I think that presents a opportunity on the long side.
Yeah, and you could argue you already started to see some of that play out in trading today. Some of the hardest hit names that have been high flyers, momentum names, actually seeing some of the biggest comebacks, at least before the sell-off gathered steam again into the close this afternoon. Eric, what's the bond market telling us right now? Is it good or bad?
So I think bond yields are moving down for two reasons. One's good and one's not good. So the good thing is that one of the focal points of the current administration is bringing down the deficit. And if you rewind 3 or 4 months when we were at 480 in the 10-year, the big concern was a deficit that had expanded to $2 trillion, and there was really no end in sight around where that expansion of the deficit was going to go. Now we have a situation where one of the big focuses is bringing the deficit down. There's even talk about a balanced budget. So that's very favorable. Now, the negative side is that the process to get there around slowing fiscal spending is a short-term economic headwind. And I think the bond market has absolutely sniffed that out, where you have headwinds to economic growth from less fiscal spending, from slower population growth, and then, of course, the uncertainty that I spoke about. So I think the bond market is seeing this slower growth environment because they are still pricing in higher inflation. So it's really a growth that I think they're really focused on, along with the deficit outlook.